welcome to the Build and Exit podcast. I'm really excited to have our first guest of the show, Paul Quirk. Paul worked in investment banking for 9 years with JP Morgan and recently started his own entrepreneurial journey and has actually successfully acquired a business over the last few months of last 6 months, 5 million turnover, 700 EBITDA. And I'm really excited to talk through his journey and what he's learned from the process, because I think this is a really powerful acquisition story. So first of all, I just want to hand over to you, Paul, if you can give us a bit of a background about yourself. Thank you for coming on the show.
Well, thank you for having me, Julie. And it's an honor to be your first guest. So you've been a guest on my podcast, which was a great episode. So a little bit about me. So I guess, as you alluded to, I spent some time at JP Morgan, probably about 9 years, most of the time in Geneva, Switzerland, but a little bit of time in London and New York. It was really interesting and fascinating, and I learned a lot, but I always had a bit of an entrepreneurial itch. I heard about a colleague who had done something similar to what I guess I've started to do now, and he was very successful. And I didn't really know at that time that buying a business was an option. I thought to be an entrepreneur, you needed to start something, have a great idea, a revolutionary idea, and actually execute on that. And it was always so difficult to think of an interesting idea. So I just kept on being a good employee. But then when I heard about this option, I found it interesting, slowly started looking into it, devised a bit of a plan on how it could work. Because I eventually quit my job to search full-time for the acquisition. So that needed some planning too. But eventually, as you said, 6 months ago, acquired this business, which is a fantastic business, and excited to have moved over to the operational side, really enjoying that too. So far, so good. So yeah, that's the high-level background. Happy to dig deeper into anything that you think may be interesting.
Yeah, it's really interesting. I think it's really interesting moving from corporate sort of to your entrepreneurial. I suppose, how quick did you make that journey? Was it something you found easy?
Easy, not too easy. So like I alluded to a moment ago, I had heard about someone who did it via I don't know if you've heard of a search fund. So it's kind of a traditional search fund. So this kind of ETA, entrepreneurship through acquisition, is taught at a few MBAs, started in the US. I think Stanford and Harvard were the two biggest ones. And there's a very kind of standard process by which you kind of raise capital to search for your business, and then you acquire it. And there's very set guidelines and rules as to how that plays out. And as an asset class, if you can refer to it as that, it's been very successful. Stanford kind of does a report every 2 years on the success of these kind of acquisition entrepreneurs, or these entrepreneurial acquisitions. So he did that, the guy that I heard about who had done it, a colleague of mine, and he did it in Mexico, was very successful, and that kind of got me thinking about this as an option. At the time, I think my wife may have been pregnant at the time, so I kind of just paused for a little bit. I thought it's probably not the best time to leave the security of a full-time job. And a couple of years later, an opportunity presented itself that I could step away and pursue this. So I did, knowing, typically from those statistics I referred to that Stanford tracks, it takes about 24 months on average to acquire a business of a certain size if you're searching full-time. So I'd kind of prepared for that time frame. I think maybe I thought I could do it quicker, and I probably did do it a little bit quicker than that, but financially prepared for that, and then set out on the journey. So it wasn't exactly easy, but I think I was semi-prepared, as prepared as you can be, I guess, because it was a bit of an emotional roller coaster, that search journey to the first acquisition. But there is a bit of a playbook, more so than there were probably for the pioneers that took this journey 10, 20, 30 years ago. So that is helpful. And then early on in the journey, I launched a podcast myself to kind of chronicle my journey and speak to interesting people to try and accelerate my learning, because even though I come from a banking background, it wasn't really private equity related. So I didn't really have a network to lean on to buy businesses. So that helped me a lot. And yeah, that's at a high level.
Yeah, really good. Yeah, because it's interesting about the journey of finding the deals. Because obviously, I've been on your podcast as well, work quite a lot on the acquisition space. So, how for people that are coming into this and thinking about doing a similar thing, I mean, first of all, how did you decide the industry, and how did you find your first deal? Like, what methods did you go through? Because there's lots of different avenues people can take, so it's interesting to hear how you find them.
Yeah. So I'll tackle why this industry first. So you mentioned kind of the high level financials of my company, but it's a window and door installation company. We also do kind of living extensions, so generally broad home improvement products. I didn't initially think about this sector when I started looking into it. I would just look at a whole bunch of different things as I was learning and kind of figuring things out. And then I, as a good investment analyst does, kind of dug into each sector and developed a little bit of a thesis, whether it was a good one or a bad one. And at first appearance, I thought this was kind of construction linked, which I later learned it wasn't. The replacement market in the UK is really booming, given the energy efficiencies. It's the oldest UK housing stock, is the oldest in Europe and the least energy efficient. So as I started to dig into the sector, I started learning there's probably some decent tailwinds and at worst an evergreen market in the UK. So that kind of got me excited. There is the kind of retail sale, non-recurring nature of the business, which some people don't like. I have my own thoughts on that for small businesses. I think generally those companies can be quite concentrated on one or two big customers, whereas that is not the case in my business. And then also you can kind of scale up marketing up and down to drive sales as and when you need it. At least that's what I'm learning so far. So I didn't completely dislike that business model. And like I said, I liked the industry. So that was, a deal came across my plate early on, and then I dug into the sector after the fact. And then I thought, okay, this is interesting. But I looked at a whole bunch of different sectors throughout the journey. I had a deal fall apart on the finish line in the fire and security sector, which is quite a popular one. And I kept an open mind. And then this specific deal came up. I was speaking to a corporate finance advisor on a different deal, and it just wasn't a good fit. I think we both agreed. And he mentioned a few other deals that he had live at that moment, one being this one. And obviously I had a bit of an industry thesis and kind of had dug into the industry. So I was quite keen to look at this. And then a few months down the line, a lot of ups and downs from that moment. But essentially that was the deal that I ended up acquiring. So that was the sector and why I chose the sector. And then to your second question on deal sourcing, I guess I used the ways most people do. I started using the classic main street brokers, if you can call them that. I found that to be quite a frustrating process, if I'm being honest. I found the disconnect between what sellers expected versus what should be fair, well, what I would think would be a fair price, given kind of what the finance terms are like and just the market here in the UK. There was a huge disconnect. I later learned that those same brokers are probably not aligned with the same incentives as sellers. So that's an interesting dynamic, but I'm not going to get into all of that. And then I did some proprietary outreach. So I tried direct mail. I didn't really like that because it's very difficult statistically to figure out, how many people are reading these. So I tried the email route where you can kind of track, had limited success with that. And then I guess probably from the podcast and building relationships, I got into kind of the corporate finance and accounting network, which you could argue is probably got stronger representation and higher quality deals. At least that's my opinion. And that was helpful because it's kind of deals that are live. So, the seller wants to sell. A lot of the information is already prepared for you. And they're represented by an intermediary that has better alignment of incentives, i.e. compensated on the sale mostly rather than a retainer. And, from early discussions with this corporate finance company, it was clear that what I thought was a fair price was what they thought was a fair price, and it just made the process a lot smoother. So if you can build those connections for any aspiring buyers of business, I would say that would be a good route to go down. But that's eventually how I sourced the deal. But I have friends who've done it both ways, main street brokers, proprietary. So, essentially there's an aspect to luck to all of this. So you need to get a little bit lucky, I think, to find the company that you eventually buy.
Yeah. And it was interesting that you're saying like the type of, like you did a lot of research on the industry. So the industry that you actually ended up acquiring in, you haven't had experience in working in that industry previously. Because obviously you're from
No,
investment
no.
banking.
Yeah, I guess unless I was going to buy some kind of financial advisory company, there wasn't ever going to be an industry that I had experience in. So it was all going to be new to me. And I mean, I mentioned kind of the traditional search model that was, popularized by Stanford and Harvard. That's generally the case. You have these MBA graduates that are young, ambitious people that want to just go out and kind of tackle one of these small businesses, thinking that they can maybe grow it, add value, maybe modernize it, or however they think they can grow it. But typically, they don't have the specific sector experience. Not in every case, but a lot of times. So, because there was a bit of a playbook and a track record of people doing something like I had done, I backed myself, and hopefully it'll be successful. But I just decided to back myself.
Yeah, no, I think it's great. I mean, sometimes I actually think not knowing the industry can be a benefit, because sometimes if you know it, you can try and micromanage all the processes a little bit. But how did you find, so the sellers of the industry, obviously, that you're buying into, I mean, how did you get them on board that you could actually run the company after acquisition with no experience? How did that journey go?
Yeah, I think early conversations with the sellers were really good. I think we had aligned goals. My approach is and wasn't to kind of come in and think I know everything. It was important for me that they kind of stay on board for a little bit and help me, not just to ensure a smooth transition, but just to get me up to speed. And that was also important to them. I think they wanted someone who would carry their business forward, and they knew it may take some time to train someone up like me, but they were fine with that. And they have been great. I mean, it's 6 months in, but we still have a very good relationship. I mean, they help out a ton, and I think they've got a bit of renewed energy, if you will, because they see me coming in excited, and maybe it gets them a little bit excited. So that's been really great and probably fortunate, because I know it doesn't always go down like that. But I think we just had aligned goals from the beginning, which is helpful, because the deal is going to fall apart 6 or 7 times throughout due diligence. So if you don't have that aligned vision with the owners from the start, it's probably a bit of a red flag. You can probably still get deals done, I guess, but definitely it helps. And it probably helps post-acquisition too, because, if you don't have the sector experience, you're going to lean on them quite heavily. And if you have a good relationship with them and you have similar goals, it just makes things a lot easier.
Yeah. And we're going to have a little bit of competition here. So how many days did it take you to close heads of terms?
Heads of terms, I don't know, to be honest. That wasn't the longest part was trying to raise the debt financing, which we can get into, but heads of terms wasn't too bad. I was away in South Africa when I had the first discussion, and I was actually away for two months in South Africa. I was still kind of searching and working during the time, but I was also, a little bit maybe on holiday mode a little bit. So I would say maybe a month after the first conversation, but it was pretty clear after the first call that we were pretty aligned. So it could have gone quicker. I think also maybe I think at the time I had other live deals at the moment. So I just wanted to make sure that whichever one I decided to go down was the right one, so I could commit all my energy towards that. So it could have definitely been quicker.
Yeah.
But maybe a month.
Okay, it's not too bad. It was just a little bit, because I actually signed my heads of terms in one day when I did my deal, because we had a few conversations before the there was quite a bit of time trying to get the financials from them, so there was a few conversations back and forth. So anyway, I'm always interested to hear how long heads of terms takes, because sometimes they can take months. So yours wasn't too bad, actually.
No, not too bad.
Yeah. So in terms of the financing then, what type of financing did you go for in the end for the deal?
So, I mean, I guess at a high level, the capital structure is a little bit of equity, a little bit of debt, and a little bit of seller financing. And with this business, I guess what's nice from a management standpoint is it's very asset light. There's not a lot of capex and there's not a lot of inventory. It's mainly just work in progress. So it's, makes it easier to manage. However, given that there's no assets, there's no debtor book, it's more complicated because there's no assets to use as collateral, I guess, or to leverage against. So purely, it leaves you with cash flow loans as the only option. And then I mentioned there's a non-recurring revenue component. So kind of, there's a little bit of added risk around that. So it was very complicated. I had to go down kind of the alternative lenders because your Main Street banks won't look at kind of an outside manager buying in. So the options were limited. And around the time where I was, I had a about 5 lenders on board with indicative terms. And then at that time, kind of the war in Ukraine broke out, inflation picked up, and they all kind of went from yes to no. So I had to go back to the drawing board and look again and eventually come up with a solution where the amount I wanted on debt had to be less than what I would have liked. And fortunately, I guess going back to the good relationship with the sellers, they absorbed a little bit of that to shift it onto the deferred. And then the equity component came from myself. And then I have a few minority investors that have come on board, but for the most part, it's me. And so I think that's it at a high level, but it definitely wasn't easy. The debt market, I think, at the best of times in the UK is not easy compared to what I hear of friends and people I know doing it in other countries. But that's not to say it cannot be done.
Yeah. And out of interest, I mean, when you went for the cash flow financing, were they asking for cash flows and forecasts?
Yeah, so it's pretty complex. They'll want to see basically an integrated 3-statement model on the historicals, and then built out a forecast from there, incorporating kind of the debt and servicing of that debt as you go forward. So, I mean, I don't have an accounting background. I have, I guess, like a kind of more an investment background. So it was not the easiest thing to do, but eventually, I tackled it and could figure it out. So I think it's probably worth having someone who has experience to do that for you, because when you go and approach the lenders, I think they use that as a filtering mechanism, right? They know not everyone is going to be financially savvy, but they want to see if you, I think, can do a good job and put in that work as just a first test to see, like, okay, is this person worth us backing? Because they're essentially investing in you, even though it's debt, not equity. They're taking some credit risk on you. So that was quite complicated, and it took me some time. And then every lender you speak to has different lending terms and different amortization schedules. So you've got to tweak the model every time. And then they want to question your growth rates and everything. So you want a model that's kind of scalable, because everyone's going to ask you to change this, change that. And if you just kind of hard-coded everything, you'll break the model and have to start again. So it's quite an important piece of the puzzle. No one really ever talks about that. You probably know a lot about that, Julie, given kind of your experience in the world that you live in. But kind of from the people looking to acquire, it's really not something that people spend a lot of time with. And that has to go alongside a broad investor or lender presentation. Like, they want to see a business model, forecasts, what the team looks like, where do you think the growth levers are, etc. So it really is almost like you're reaching out to equity investors to raise equity capital. The debt lenders want to see the same things.
Yeah, we would probably call that a bit of a high level pitch deck with like the information of the accounts. Yeah, well, it's good that you managed to pull that together, because they can be complicated, especially if you're going for quite a high value loan. So yeah, that's great.
Yeah, that's probably one skill set I could pull from my prior life for this journey.
Yeah. So this is really good. So it was successful. You closed heads of terms and you did the due diligence. Did you find, because of the route you went down, that the seller had good information, or were you questioning the information through due diligence?
Not really. I mean, there were a few bits and pieces where I wanted to dig deeper. But I think, again, going back to the benefit of dealing with like a corporate finance intermediary, kind of the data room is already almost kind of somewhat populated. So you start asking for things and digging deeper, and it's already there prepared. Not for everything, but already the starting point is just, so far ahead of the curve. So that was quite helpful. There were definitely things like industry-wise that are particular, if you will, about this industry that, I'd want to dig into a little bit more. But for the most part, there were no major red flags. I mean, like I said, there were a few contested issues, as there always are. But I say contested, it wasn't that contested, but I mean, you kind of debate a few things. But for the most part, it was pretty smooth sailing, at least in terms of dealing with the outgoing owners.
Yeah, and I think it's really interesting, because I think it's brilliant you found it through this corporate finance seller, because, I mean, we know doing with the exit side and the buy side is, I would definitely, this is where it comes down to the seller really, is I think when you're going, if you've got the information prepared ready for the buy side in the first place, it makes everything a lot smoother. Because I just know from experience is once you start seeing poor information, you start distrusting the numbers, and then you start getting lots of different questions. Whereas if someone's giving you the information and you're trusting it, and it looks sensible. It's answering probably 60-70% of your questions. It makes everything a lot easier.
Absolutely.
So you successfully closed. So how are you now post acquisition? I mean, what have your challenges been, would you say, since post acquisition?
Yeah, so it's been 6 months. I think it's safe to say I'm now an expert. No, I'm just kidding. It's been good. I mean, like I said early on, the two outgoing owners, or two of the three outgoing owners, have stayed alongside me and have just continued to, I guess, do what they've always done, and they're doing a great job. So that's been really helpful. So I've almost kind of seen myself, or approached it with them and the rest of the staff as a bit of a consultant for hire, if you will. Like, there's interesting initiatives and things that they wanted to do and that I think we should do, but no one's really had the bandwidth. So I kind of take the lead on those things. I hired in and basically revamped the entire finance team. I think we discussed this, I think, when you were on, the importance of having a finance team. I debated outsourcing it to kind of a fractional CFO, which I think we debated at the time. But I thought, for me, for this first acquisition, I wanted the people in-house, and that's been extremely beneficial to kind of have robust forecasting and kind of management accounts done on a monthly basis, because these things weren't really done in the past. So really, that's been helpful. But in general, the team, the people are really good, and there's challenges now and then. Like, I think everyone asked me for a raise within a week of being here. So you've got to handle those conversations, and a few other kind of people-related issues. Not issues, that's not the right term, but there are some HR components that I probably didn't anticipate, being some of the operational hurdles that I have to tackle in the first few months. But so far, it's been okay. I mean, I think we had our best January and February on record, which is good given what you hear the news headlines are every day, every week, about like recession and cost of living crisis, and so that gave us a little bit of anxiety last year. But so far, so good. It's very hard for me to try and claim victory or anything, because everyone else has just been doing what they've been doing in the past. So I guess I'm just lucky to have inherited a good team. So I'm just trying not to break anything at this point.
Yeah, and I think you're lucky. I mean, maybe this is the size of deal, because going for a 5 mil business, I mean, we tend to find anything lower than 2 mil tends to be more owner operated, and the bigger you go, so it seems like yours was quite self-sufficient, the deal that you're buying. So that's obviously benefited you. Would you agree that it was kind of running properly before you bought it?
Yeah, absolutely. I mean, for sure, the two owners that have stayed on are important to the business, and when they do need to be replaced, we'll need some high caliber individuals. But below them, there's very strong second tier management that are capable of doing their job, and then probably in total we have 30 people working here, and for the most part everyone does a really good job and is keen and eager to kind of push the business forward. So that can be helpful, because I can imagine as you go smaller, the owner kind of, I don't know if you've read E-Myth or if the listeners have read that book. If not, I recommend it. But you kind of get these people who were employees of a business in the same sector. They decide to spin out and start their business. Then they get to kind of 2 million, but in reality, they just have a job, but they're the owner of their business, which is their job. And they haven't really kind of gone to that next level, which I think this business was able to get to. So that is definitely a helpful factor, I think, because if I could try and imagine myself doing what I do now, plus what the two owners that are still on board do, I think I would, I'd probably sink quite quickly.
Yeah, it's really interesting. It's a really good story, actually. I think there's a lot of people out there. There's a lot of people going into acquisitions at the minute. So it's nice to hear success stories of people that have, sort of moved from a corporate world, entrepreneur, and then actually successfully acquired. So it's really good. So what would you say is your biggest learning from this acquisition?
That's a good question. I think, so in terms of the actual acquisition, I think I kind of maybe touched on it earlier, but having the alignment with the existing team and especially owners, if they're going to stay on board, is important. I think it helps you close the acquisition, like when times get tough during negotiations or during due diligence, having a good relationship with the seller is helpful. And then post-acquisition, it's just massively helpful. So that would be one key aspect. And then just don't underestimate the people side of it. I think coming across as humble, wanting to learn. I'm talking about myself as the new owner. Like I said to everyone quite early on that I'm the dumb one in the room here. So if you don't mind, I'm going to be asking lots of questions and leaning on you to help me. I didn't want to come across, and I couldn't afford to come across as someone who's the boss, kind of that have that mentality, even though it's not really kind of my personality. I think coming across as humble and maybe a little bit curious is helpful. It gets everyone on board and actually helps you learn quicker, I think. And don't underestimate the search. If I'm going kind of a little more back in time, it is not easy. It is definitely tough. It's rewarding when you get it done, but it's not easy. So I would say don't underestimate that. Like I see some people trying to do it part-time and kind of umming and ahhing. It really is a full-time commitment, I think. I try and help people and share my knowledge and resources with my podcast, but hopefully I don't make it sound like it's an easy endeavor, because it's not, but it's definitely rewarding, and operating, if it fits your lifestyle, is great too.
Yeah, definitely. No, it's really good. It's a really good story. So what's next for you then? What's your future plans? Are you looking to do more acquisitions?
Yeah, I'm definitely open to it. I don't know if it's funny. I guess it's a nice aspect of maybe having the track record now of acquiring on business in a specific sector. And maybe because of the people I met through the podcast, I just get deals sent to me now, which is, it's interesting after 2 years of like fighting tooth and nail to try and get people to show me deals. So that's an interesting dynamic. And I'm definitely like, the plan is to grow this business. You can grow inorganically relatively, I don't want to say easily, but it's like the CapEx investment is not significant. You can do it in a smart way, but the attraction to growth is obviously you could buy an existing brand, which is helpful, and the staff that goes along it, because the labor market's quite tight in this industry. So definitely looking at other deals, and so anyone, if you have any great deals in sectors, please send them. But I don't plan on sitting around. So the plan is to grow both inorganically and organically. The existing business now, I think it can even capture more market share in its kind of local region. So that's also something that I'm focused on. So yeah, it's early days, but keeping all options open and looking at any way that can kind of facilitate that growth plan.
Right. And have you considered, have you thought, because what I find is people acquiring don't always think about the end goal. I mean, have you considered an exit strategy at some point in the future?
Not really. I didn't. I guess that's why I went for, I don't want to say small business, but like something that I could have a significant majority ownership in with kind of the equity that I had, because I didn't really want to be a forced seller. Obviously, I have a handful of minority investors, but for the most part it's me, and I will offer them a liquidity event in kind of 5 years we've discussed, and I could probably buy them out at that point or kind of refinance or whatever, because I know they may want a liquidity event. But if the business is generating a lot of free cash flow, I could use that to reinvest in other interesting opportunities. I don't necessarily need an exit. I mean, of course, if something super compelling comes along, I'm not going to say no. It would be silly to myself and to the other investors to not at least have that conversation. But that'll be in years to come. But it's definitely not necessarily an end goal. I know a lot of people have like a kind of aggressive, or a specific strategy to get to, and that often means you have to acquire quite aggressively. That's definitely not necessarily my plan. Like, there is a lifestyle component to it. Yeah, I mean, I don't know if that really answers your question. I guess high level, not really, but open to it.
Yeah, I think it's nice though. I think there are a lot of people doing sort of like the buy, build and sell. But, at the end of the day, my view is what I've learned in business is I'd never grow it organically again, not from the ground up. I'd always buy it first. So, you've gone in somewhere, you've got a bit of a lifestyle that you enjoy, and there's nothing wrong with wanting to keep that. So it's just a different type of strategy to someone who's buying up to exit, really. So no, it's good.
Yeah. I think both works.
Yeah. So we're coming to the end then. So it's been really great hearing your story. I think this is going to be a really positive story for a lot of people. So where Where can people find you, Paul, if they've got deals, or maybe they want to hear your buy and build podcast? Where can they find you?
Yeah, so I mean, on social media wise, I guess I'm on LinkedIn the most. Yeah, pretty much only on LinkedIn, and I do have my own podcast called the Buy and Build Podcast. If you're interested in listening there, it's mainly focused on as it says, buying and building businesses with a kind of bias towards acquisitions and small business, and probably UK focused, European focused. So we have on a lot of interesting guests like you, Julie. You've been a fantastic guest, and we're probably about 60 episodes in now, give or take. So that could be an interesting resource. And if you want to send me a message on LinkedIn, it's just Paul Quirk. I think you can find me. And yeah, happy to kind of add people to my network, meet, discuss with like-minded people. I think it's really cool to this kind of community in the UK and abroad of these small business acquisition folks, whether they buyers, people look for like service providers and things like that. I think it's a really collegiate ecosystem. So I quite enjoy meeting people. So feel free to reach out.
Yeah, great. I love it. I love this sort of SME acquisition space as well. So, well, thanks so much, Paul. It's been really great hearing your story, and thanks for sharing it.
Well, thank you, Julie. Thanks for having me. I'm excited to listen in to future episodes of the podcast and learn more from you. And yeah, stay in touch.
Thank you.